Here's another example. For the bottom trend line, we connect the swing lows using the same logic. The trend line touches wicks, candle bodies, or both, whichever gets the highest number of valid connections. So don't overthink it. Trend lines are tools, not laws. Use them to guide your analysis, not as a strict rule for entry and exit. Now that you know how to draw trend lines correctly, let's take it a step further and learn how to use them in combination with price action to find high probability trade setups. We use trend lines in combination with price action in two main ways. First, trend trading with trend lines. This means trading in the direction of the trend. Second, reversal trading with trend lines. This helps identifying potential trend reversals. Let's start with trend trading first. One of the best ways to trade with trend lines is by looking for areas where support or resistance aligns with a trend line, also known as high confluence zones. A high confluence zone is an area where multiple factors align, making it a strong potential trade setup. These are areas where many traders are watching, leading to higher trading activity and potentially stronger price reactions. Let's walk through a real example to see how trend traders use trend lines and confluence for high probability trades. First, we determine the overall trend. If price is making lower highs and lower lows, we are in a downtrend and look for short opportunities. If price is making higher highs and higher lows, we are in an uptrend and look for long opportunities. In this example, we confirm that we are in a downtrend, so we're only looking for short trades to stay aligned with the bigger picture trend. Next, we place our trend line by connecting at least two swing highs in this downtrend. We extend the trend line forward to act as a future resistance level. This allows us to anticipate potential trade opportunities if price retraces back to the trend line. We then look left on the chart and spot a previous support level that price has now broken below. This level is likely to act as new resistance when price comes back up. We mark this area as a key level. Now we check where our trend line and resistance level intersect. This is the high confluence zone because multiple traders are watching this area for potential short opportunities. We do not enter blindly, we wait for price action confirmation. Now you might be thinking, if we've identified a high confluence zone, why not enter a short trade immediately when the price touches it? The answer is simple, because the price can still break through these areas and reverse. That's why we always wait for confirmation. As price reaches the high confluence zone, we closely monitor its reaction. A bearish rejection appears when the price touches the area. This is typically indicated by two red bearish candles rejecting from the level, but this is not an entry signal yet. A reaction alone does not mean a reversal. Many traders make the mistake of entering a trade as soon as they see a price rejection, but this is not enough confirmation because price could still break through the level and start an uptrend. Here's the trick to confirm the trade. We draw a short-term trend line on the immediate move up and wait for a break of the trend line before entering. Why is this important? Because while the overall trend is bearish, the short-term trend is still bullish.